With the major home loan crackdown that APRA has brought in, we need to figure out what this actually means for us as property investors and homeowners. This could mean the difference between purchasing something and not being able to afford a loan. So if you're interested, keep watching. Hey guys, my name's Ravi and welcome back to Personal Finance with Ravi Sharma. If you're new here, smash that subscribe button because I talk about real estate, cryptocurrency, and financial freedom. So this is actually a follow-up video from a few days ago where I actually talked about the major crackdown that APRA is introducing. Now, if you're interested in that, definitely check out the video up here. But in this video, what we're gonna do is dissect what the new changes are and how this actually affects us when we're borrowing money. Potential home buyers able to borrow less as property prices rise after APRA interest rate change. Potential home buyers face the prospect of being able to borrow less to buy property that costs more and more this spring. Someone applying for a home loan from now will have their maximum borrowing capacity reduced by tens of thousands of dollars after a move by the bank regulator to make sure borrowers can still repay their debts when interest rates eventually rise. So effectively, there was a discussion around whether APRA was going to come in and, have a cap on debt to income ratios. And that effectively is what I, spoke about in that last video, which was around how your income, let's say it's 100K, then your maximum capacity there would be 6 times that income. Effectively. Obviously, you have to go through the bank's, servicing calculator, but that's a good rule of thumb. Now, that was one way they could address it. The other way was to actually increase the buffer rates that banks have. So for example, if you go in for a loan and the loan amount is actually, say, 2.5%, the bank would actually add another 2.5% as their servicing buffer and their floor rate increases so that they can see that as going, well, yeah, we know that you can make the repayments on 2.5%, but according to our calculator, we want to see if it's available for you to make the repayments when it's 2.5% your interest rate plus the 2.5 we actually add to it. Now, APRA has come in and they've increased what that buffer rate should be. Banks must now check if borrowers could afford their repayments if interest rates were 3 percentage points higher than the loan amount product, up from the previous buffer of 2.5%. Under changes announced on Wednesday by Australian Prudential Regulation Authority. This is likely to reduce the borrowing capacity for the typical buyer by 5%. Now, 5% doesn't sound like a lot, but we're going to break down what that actually means in terms of dollar cents. Comparison platform CanStar estimated someone on an income of $90,500 a year would have their maximum borrowing capacity reduced by $30,000 by a move to a 3% buffer. Under a 2.5% buffer on top of the average variable of 3.13%, the buyer could borrow a maximum of $578,000, but with a 3% buffer, this drops to $548,000. Now, what's my opinion on the fact that they've got buffers? Well, to be honest, I think they need it in the system where a lot of people that are buying property are just emotional buyers. They are paying way above what their means are, and they're, effectively buying things to impress other people they don't even like. Let's just put it how it is. The emotion comes in because they're buying a house that has, say, 4 bedrooms, but in reality, they only ever need 3 bedrooms. And that even extends out to, people buying houses that are 6, 7 bedroom homes, but in reality, there's only 4 people that live there. So this is the issue that I have where people are borrowing way above their means, but these buffers that are in place is really there to protect the stupidity or the stupid money from overextending themselves. Someone on an income of $59,800 would lose $17,000 in buying power, while a higher income earner on $130,000 would be short $47,000. At the same time, economists say prices will still rise as the regulator's move is too modest to push prices lower and will likely slow the percentage pace of 20% annual growth in home loan values to a similar gain next year. So that's the follow-up to this entire argument or discussion is that are these changes actually going to work and are they going to slow down house prices? Now, to be honest, I don't think so. I think the areas that are already overextended have so much demand that you might have 1 or 2 people not be able to afford the extra pricing, but we still have way too much demand for the supply that's actually out there. Now, I'm talking about good quality homes. Yes, there are people out there that just absolutely love a particular location. So if there's only 3 properties available and there's 10 people, after this change, if instead of 10 people, there's like 7 people now, 7 people is still higher than the 3 properties. I guess this is an example, but that's the reality of what's happening, So in effect, despite these changes and, credit tightening and things like that, it will have some sort of an effect to maybe have modest growth. It might cool down the amount of growth we have, but I don't think we're going,
oh my God, this is like going to correct itself and we're crashing now. Yes, 30% drops. Oh yeah, I told you, Ravi.
In practice, not all buyers would be offered so much credit and not all buyers borrow the maximum available. While some lenders such as CBA have already lifted their serviceability floor, the amount someone can borrow depends on whether their income is enough to cover the repayments and whether their deposit is enough to afford the property, and the banks also consider borrowers' monthly expenses. The maximum figure assumes a borrowing slashes their annual non-housing expenses to a frugal $16,500 for a single. So we can see this table here, estimated borrowing power by income level. So the low, which is the 25th percentile, the average income is $39,000. Now here, under the old system, you'd be able to borrow $166,000, but under the new system, it only changes by $8,000 to be $158,000, which is not huge. Now, a lot of people are probably sitting in this medium to medium high range, and that's $59,800 to $90,500, and the changes here are about $17,000 and $30,000. In the high 90th percentile is $130,000 as the annual income. This one obviously gets affected the most, but again, $47,000 isn't going to change a huge deal. But in expensive neighborhoods, mortgage brokers say buyers are increasingly trying to borrow as much as possible to keep up with the price boom. In pricey Sydney, Shaw Financial's chief executive, Theo Chambers, is seeing about 90% of clients hoping to borrow their maximum. This will push them back even further, he said. I understand it might help affordability, it might soften the crazy prices, but it reduces someone's ability to borrow. The problem is the Sydney property market is so expensive, they're already struggling, they're already compromising. Even so, Mr. Chambers warned that a later increase in interest rates could be a significant rise in someone's repayments and was concerned that not everyone was calculating affordability of the future. So I agree with this, and it goes back down to my first point, which is we need systems like this, otherwise we have a GFC type of situation where everyone's borrowing and they're like,
oh yeah, it's easy, it's 2%, it's cheap debt, let's keep borrowing.
This pretty much goes, well, it's a precursor for if we did see interest rates rise, it means that people could still afford it. And this goes back to the initial argument that people have about, or barrier that stops people from actually investing. They're saying, well,
this is all great, Rafi, but what happens when interest rates rise?
The thing is, when you actually sit there and look at the servicing calculator and you see how much you can actually afford based on your expenses and whatnot, it's already being based on 2 to 3% higher interest rates than what we're already seeing. I don't forecast that we're going to see a rapid rise by 3% interest rates without other factors being in play. So I don't think that's coming up in the next couple of years. So this is something to keep in mind, that the banks are also looking out for you in the sense they don't want to give you money that you can't afford to actually repay, because that's a negative on their bank balance. In Melbourne, mortgage house Yarraville's Gary said first home hopefuls starting out in their careers were drastically impacted by the change. They are struggling at the moment, and adding that 0.5% buffer on top or already high buffer, it will impact them. He said he had seen quite a few buyers looking to borrow their maximum after missing out on auctions over the last couple of months, and said many had done their research and knew that rates were likely to rise in the future. As for the buyer who wants to borrow, for example, $600,000 from a borrowing capacity of 1.2, this change would not affect them, he said. And this is the issue that we have right now, is people go, well, what's my borrowing capacity? They'll go to a bank or a broker and they say, oh, well, you can borrow up to 1.4 million.
Awesome. I'm going to go and borrow something for 1.4 million because I can afford that now.
And the broker or the bank person might say to them,
well, your borrowing capacity is 1.4, but if you don't need to borrow 1.4, then I don't think you should.
So what happens in that case? Well, usually they're going to come back and they say,
well, you know what, we can't afford 1.4, so instead of living on that street, we're going to live on that street, and that's because, hey, I can afford 1.4 and people around me will know it too.
Will, director of 4040 Finance and a specialist in first home buyer market, said while most borrowers would not be affected as they are seeking a smaller loan than their limit, the rest would need to consider compromising. The clients that are stretching themselves with a lot are in this market to try and keep pace and buy what they are intended to buy. This means some clients who are approved up to their maximum will now have to recalibrate their budget significantly. It might mean a slight adjustment on property size, land size, and location. CanStar Group Executive Financial Services Steve said the change to borrowing power might make a difference as to which suburbs a buyer could afford in a larger city, but would not force buyers out of the market. He said the change would likely affect first home buyers who do not already have rising equity in their current home, like upgrades to do, and investors who are now set to be assessed for serviceability across their total property portfolio, including their family home. If you're not borrowing the maximum, this means nothing to you. If you're right in the margin, it matters. What we know is interest rates will go up, he said. What we don't know is when. And that's the bottom line, right? We don't know when interest rates are going up, if they are going up. And the people that do think they are going up, they think it's going to just go up overnight and that's just what's going to happen. I don't think that's going to happen. I think we have to move up slowly because there is so much debt in the system. And the way that the modern monetary theory is working and system is working in Australia at least, it's that we rely on debt and inflation to drive our economy. So we can't suddenly decide tomorrow at the RBA meeting, we're going to go,
Oh, by the way, we're going to increase interest rates by like 6%. Oh, damn.
what are you going to do then? At the end of the day, we can't have that happen because we would have the whole system implode. We need to move up in steps. And if you have a strategy and you know what you're doing in terms of cash flow, because that becomes very important in a situation like this, then you're able to adapt and pivot. This is why it's important to not just go,
Hey, Ravi's a buyer's agent, just go buy property because that's what he's advocating for.
no, I don't say that. I say, if you want my services, great, if you're looking at real estate. But me personally, I don't have all my money in real estate. I look at crypto, I look at trading cards and alternative assets because that excites me with the returns I can get from there, but it also diversifies my risk with having all of my eggs in one place. For you, it might be ETFs, it might be shares, it might be crypto as well. You've got to find out what your plan looks like holistically rather than just listening to people online and say, oh, well, hey, real estate's great, I should buy it because everyone else is buying and everyone's making money. Well, Christmas is going to come around this year and everyone's going to be hanging out and they're going to say, well, I bought a property 3 months ago and look how much money I made. The FOMO is going to kick in. And the thing is, this doesn't affect a lot of people. The changes aren't massive, but I think this is step one of a bigger plan that's going to come in over the next couple of years. So, as I say with everything, this is not financial advice. None of my videos are financial advice. It's a prompt for you to start taking this seriously. Get some activity, get into the market and start figuring out what's important to you. If you need the help, there's links in the description below. You can get a strategy session, which they book out fairly quickly, so keep an eye out for it. And if you want the first chance to get the strategy session, join the Patreon community. I talk about things every single day around cryptocurrency, NFTs, and real estate. So if you're interested, then definitely head to the description below and click any of those links. But thank you so much for listening. And if you haven't already, subscribe because I'll be back in like a few days and you can see my face again. So I'll catch you guys then. Thanks, guys.